good morning, Don. I just hit the record button, and you and I are.
I better comb my hair.
Yeah, comb your hair. Yeah, lick your eyebrows. But it is mid-May. We are still. I'm in Pennsylvania, and we are still in a lockdown, and the governor is still giving signs that he's going to extend it. Right now, we're extended to June 4th, but we don't really have good plans for opening. You're in Georgia. Your governor has about 3 weeks ago began, opening up carefully, and I wish we would do the same. It's been a very, very interesting month of May. We send a thing out, a weekend update every weekend, and if every Saturday, if somebody is watching this and wants to get that weekend update, stonebornportfolios.com, and there'll be a pop-up after you're on the site for 30 seconds or so asking you if you want the free weekend email. Just do that, and we'll give you our commentary and our statistics every week. But last week it occurred to me that what the market has been doing just doesn't make sense with what the economy is doing, and it's detached. Interesting that today there was an article in the Wall Street Journal just describing all of that, how what the market has done has not really matched up with what you'd expect, given unemployment, given the lockdown, given the loss of revenue, given the unprecedented spending by our federal government. Given the Fed intervention that's going to ultimately, I think, has to result in inflation. So how come the market was going up? Well, this week it turned around, and we've had several down days. I think we're, as of the close yesterday, I think we were probably down 3.5%, something like that for the week. I think volatility is still kind of the watchword here. I mean, for you and me, it always is. But you were telling me that you kind of put some things together, some thoughts together, and you're so good at this. You're kind of a PowerPoint ninja, and I'd like to take a look at it if you don't mind showing it to me and see what you did. You'll have to share your screen and start your slideshow.
Oh, okay. Now that's the real challenge to get to get all this stuff done. Let me see here. Look at here.
Wow.
Volatility.
An analog man dealing with a digital world.
I did this yesterday, kind of put it together, but this is what we're dealing with, and this is what I think that we're about. From I got a couple little hokey examples. I got a couple of questions for you, and then at the end I want to deal with some reality, some real things. Then I'm gonna kind of pitch that maybe to you and give you the mouse to do that. But
okay,
let's go through real quick here. I got a couple of little bitty hokey things that I like to do. Let me see if I can get. Okay, we've got a little test going here. Me and Paul, we got us a little competition going. And First year, Paul makes 5%. Old Don, the stud, makes 15%. And then year 2, I'm cleaning him out.
I'm not liking this.
At the end of the 3rd year, if we had $100 when we started, at this point in time, Paul has $115.76.
Okay.
That's pretty bad if you really want to know the truth. Really want to know the truth. But since I'm so good and I've got the mouse in my hand, I have accumulated $152. 115 for you and 152 for me. And so we pitch it on to the next year. Well, I tried something new and it didn't work, but it was only 20%.
Yep. Okay.
Just think about that.
Yeah.
I was at 152 and you're at 115. And so it's pretty obvious who's the winner is.
Well, you are.
Yeah. Who wins?
I think you do.
It's a statistical tie.
Huh.
I beat you by 1/10.
Wow. by a dime.
And there's a lot of morals to this story. Is the first one is that in your case, the consistent compounding, you didn't have any negativity. See, this is part of the volatility things that most people don't get.
Right.
And I've had some people question me. I give some talks and they say, yeah, but you put that 20% at the end. It doesn't matter. It makes no difference where in this lineup does a 20% fall. The stats are the same no matter what.
Huh.
It's consistent compounding. That's one of the cornerstones.
Persistent consistency.
I can't use all them big words. I agree with you. All right, another quick example. Year one, let's look here at 10%, 12%, and 8%. That comes out to 30%.
Right.
Okay, over here, we got 40 and 10 is 50, and then you subtract 20 from 30, it comes out to 30%. So in reality, we both have an average of 10%. But this is where volatility comes in. There is a price for volatility that's kind of quirky. And unfortunately, I had some pretty good junior high math teachers, so they taught me a little bit. But if you do this on a compounding basis, the growth of $100 in the chart here, I mean, in the addition year 1, 2, and 3, well, it's an average of 10%. We clearly compound and the end result is $133 to $123. It compounds only at 7.2%.
Yeah. And that car is compounded annual return, right?
Compounded annual return. I'm sorry.
Doesn't mean a Lexus.
It wasn't a Chevrolet. So, but the thing that I like most is the little saying at the bottom: math doesn't have a bad day. And we've spent an inordinate amount of time, and nobody likes to pound on volatility much better than I do.
Yep.
All right. Got a quick question for you.
Well, all right. I didn't know I was going to be tested.
But anyway, is it possible for a 33% loss to wipe out a 50% gain? Just, you don't have to answer yet. I just want you to look at it. Just take a second look at it. And I got a little demo here.
I kind of feel like this is a setup question.
Yeah, it might be. Okay. At the end of this is 100.
Yep.
And let's just say it's 100 pineapples. I don't care what it is. Doesn't matter. Bicycles or pineapples or whatever.
Yep.
Just and we add another 50% on there. So we got 150 pineapples now, or bicycles or whatever, dollars. Right. It really makes no difference.
Yep.
And then we get to my question.
Okay.
Is it possible for a 33% loss to wipe out a 50% gain?
Oh, now I'm seeing it.
Yeah. Well, let's say we should all agree that we got 150 pineapples up there.
Yes.
And we had to take a third of them out.
Yep.
And so you get back to 50. And that's the math that they don't teach you when you get your MBA. I don't care if you go to Harvard or Yale or Yale or wherever it is. This is just something that nobody understands. And it brings on the next question. Give me your best shot at what kind of gain it'll take to get back to 150. You should be able to pull that one off.
Well, I would say it's going to take a 50% gain.
Right. So this works both ways. The easiest way to wipe out a 50% gain is to take a 33% loss.
Yeah.
If you take a 33% loss, it's going to take another 50% to get back even.
Yeah.
And maybe that's the reason I didn't get into Harvard. But bottom line, it's just some old Georgia math that doesn't ever have a bad day. And I know these are kind of hokey little examples.
That's a pretty effective demonstration right there.
Yeah. Well, thanks. But I've only been doing this about 30 or 35 or I don't know. so many years. And I've had people come up to me after a talk and try to argue with me a little bit. And I said, well, okay, let's make up a game and you decide. Mm-hmm. But it also points to some of the reality things that we're going to deal with in the back end of it. So,
okay.
Now, I'm going to turn this, let's see if I can get up here, and I'm going to remote control, and I'm going to turn it over to Captain Montgomery here. Let's see. Have you got it?
I have got it.
Oh, yeah, good.
Yeah, I do. You know, I mentioned before we started your presentation here that we do this weekend update. This is a little snapshot from it. And this is as of the close on May 8th. So it's almost a week ago.
Yeah, last Saturday.
Right. And we're taking a look at what we call our NDX defensive growth. It's a moderate, in our view, moderate risk portfolio. You and I have almost all of our personal monies in this, you know, being of advanced age and wisdom. The aggressive is a bit too much, and being of advanced age and wisdom, we think that the risk is manageable in this area. But for others who don't, we've got to manage volatility. But there's a couple of things to see here. Just looking back over a week, over 1 week, we can see this defensive growth here was up 60 basis points. You know, 0.6%. During that same period of time, the S&P was down 1.75%, 1.75%. When you begin looking at these things, you see those there, yeah, that's important. And why is it important? It's important because when we look over here, we start to see that when you, if you can control how much you're losing, you're also controlling how much you need to gain to stay even. So look at this, between our defensive growth portfolio and the S&P 500. This is an important number. This is a more important number. Drawdown is how far off the top are you at any given moment from a new, how far from the last time you made a new high. The S&P at that point was down almost 17%. The portfolio was down a little over 2%. Now the big question is, how much is it going to take to recover? And that's why we include this column. Well, I don't think I've ever seen this statistic in a series of charts by anybody else, but it's where you and I live. We focus on this. And so for our portfolio to get back to even, we need another 2.2% growth, and we'll be making new highs. We look at the S&P 500, and they're at 16.75 that they're down. It's going to take 20% for them to get back to where they're making a new high. This is what lets me sleep at night. This is what allows me to be invested and not worried about, on any given day, what's happening in the market. This I would have trouble living with. And so for our sake, we watch these numbers, we post these numbers, we send these numbers out, and we preach this stuff wherever we can. I love this Icicle picture. This is a picture of drawdown over time. The blue is that defensive growth portfolio we were just looking at. The red is the S&P 500. This big red icicle hanging down here, that stalactite there is that's the financial crisis back in 2007, 8, and 9. This right over here is the third quarter of 2018. If you lived through that, you remember how volatile that was and what a V bottom is. Over here is the COVID pandemic crisis. And you can see how the portfolio has reacted at these different stress points in the market. The portfolio, yes, it has lost some, but it doesn't lose nearly as much. So it's back making new highs, typically long before the market is. It doesn't need to work nearly as hard in order to keep making new money and reach investment objectives. Those 2 hours there are pointing to where we are today. What's going on today. Right now we're in a almost like a 4% drawdown. Right there it says, I'm not sure when this was updated, but
actually it's a couple days old.
A couple days old.
I think we're a little closer than that now.
Yep, and the S&P total return is down 15. That's what those 2 arrows point to. Let's take a look at, we call these stone barn days, and we've taken to kind of, when we see these things happen, it's nice at the end of the day, one of us shoots the other a text. It was another stone barn day. We've even gotten down to where we just abbreviate it now and send the 2 letters SB. That means stone barn day. But for this portfolio, let's take a look at a couple of days here, recent periods. This is this past week on May 12th.
Tuesday. That's
Tuesday. We're on Friday right now. So we're looking at one of our accounts here. This is a screenshot of a live account. And you can see that for the day, that portfolio lost next to nothing. It was a down day in the market. How much down? The S&P was down over 2%. We were at break even. I mean, 5 basis points is what our portfolios gave up, because we're trying to manage the volatility and doing so effectively. Here's another look. This is another day. This would have been Wednesday. The S&P was down 1.75% that day, and the portfolio was up 54 basis points, or a little more than 0.5%. At the same time, the market was down. The NASDAQ was down. The Dow was down. Everything was down. We actually made money that day. And that, you start putting things like this together, you add this up, there's 2 3/4% the market was down, and we were up 50 basis points. That happens more frequently than you'd think. And so over time, that stuff makes a difference. Now, it doesn't always work. We've got to admit that it doesn't always work. This is yesterday. Nothing's perfect, but still, put it all together, the portfolio is ahead in a market that is volatile and has fought to go down this week. We are still at break even or above. This was Thursday. We're on Friday. The market was up 115 basis points, and we were down 41. There's a 155, 160 basis point spread, but it doesn't bother us. We didn't lose that much, and put the other days with it for the week, we're still ahead of where we were. We're still up 10 basis points on a week. We got another day to go here. I'm looking at it right now. The market is down 30 basis points. We're up 23. So this is the way it works. This is what excites us. This is why we invest this way ourselves. You kind of set me up with a couple of questions, and you just quizzed and tested me. And now this is more of an opinion question than anything, but what do you think here? What's the major benefit of investing like this and managing volatility and using kind of the stone barn approach to this? That sounds kind of hokey to say stone barn approach, but that really is what it is. We're doing what we put on our website. We're living it every day, and we're showing you what we're doing. What do you think is the best benefit of
that? For you, it's sleeping at night.
Absolutely.
When I look at somebody who considers the service that we're offering, it's not a sales approach of a product or something like that. It's more of if you buy into this, you're actually joining what we're doing. It's just we give you at the same time that we make the decision, it's passed directly to you. At the end of a month, our monthly updates. And so it, you know, I don't look at it as, but I don't know too many people who will say, we'll do for you just exactly what we do for ourselves. And that to me is the biggest benefit, because you know, when you and I stand up and say, this is what we do for ourselves, we better be able to do it, you know. And the reason this is effective for us is that we spent years, literally years, to create the avoidance of volatility, and we learned an awful lot about by not participating in highly volatile markets. It's the biggest return driver that we have. We don't have very far to dig out of those holes. We just don't go down very much. And then really good up markets, hey, we just participate like the market does for the most part. And
yeah,
but going down is one of our bags that we really don't like to deal with very much. So.
That's right. Yeah, that's true. I look back, you know, I've traded a lot of stuff. I've traded Forex, I've traded futures, you know, in my personal accounts. For my clients, I've traded mutual funds, ETFs. I've tended to be a very active trader, a technical analyst, making, you know, regular reallocations and decisions based on very short-term indicators. And I've had some success at that. I've had a 77% year, calendar year, 1 year. I've had a 52% calendar year, 1 year. You know, I've had a couple of 30 plus years. And I've also had a lot of years where we didn't do anything, where that kind of trading didn't do anything for me. And, you know, to go back to one of the slides that you showed at the beginning of, you know, kind of these losing years and then big gains, and then losing years and big gains, and how does that all work out? Do it enough and get enough years, it can work out. But you don't get many 77% years, and that's got to carry you a long time if you're going to go 4 or 5 years, you know, with next to 0% return. And that's what happened, you know, in those accounts that I was trading. This is a much better way of investing, in my view. One of the first graphics that you see on the homepage of our website is this idea of pursuing the perfect portfolio, a straight line that has no volatility, going from the bottom left of the chart to the top right. This is as close to that as I've ever managed to do in investing. It is what, like you say, lets me sleep at night. My decisions are less frequent. I've taken a lot of the noise out of the market, and so I don't have to worry minute to minute, because the years that you and I spent putting this together, we've accounted for a lot of variables and a lot of market conditions. So I'm happy. You know, you know, people know what I do for a living, and they say, "Oh, this has got to be a tough time for you." And no, it's not at all. You know, right now I only need 2% to get back to even. You know, so I'm not worried a bit.
Well, it also, we have some built-in variables for people who are younger, and for people who are less aggressive or more aggressive, or in a lot of cases, you know, we're going to start needing to take this money out in 5 years, or some of those. So there's built-in flexibility. There is no flexibility in what we do and why we do what we do. Right. That's the thing and we continually upgrade and work at it, and this is a never-ending struggle for us personally, is to always try to do what's best for ourselves, and ultimately pass it on to other people.
But yeah, it's why working together has been, I think, very, very effective. You know, I don't know if people know, but I tend to be the lab guy, you know, the programmer that kind of tests the ideas, and Don is the never ending skeptic. which is the best thing you can have in a partner. You know, what about this? Did you think of this? Hey, I just had an idea last night. You know, I was imagining this. What would happen if that happened? And have we considered this and that? It's never ending, and it's the best thing that a researcher can have is a partner who's willing to ask a lot of questions, and then this guy knows the good ones, so he knows the right ones to ask.
I think that in my past experiences that I might have been a little lucky on avoiding some of those bear markets that have occurred. Maybe we had a plan, but I think a little bit of some of the successes that I've had might have had a tilt of luck to it, but we're trying to take luck out of it and make it a part of our plan. But,
there's an old saying, it's, you know, that timing has a lot to do with the effectiveness of a rain dance. You know?
I think that's a good one to close on, Paul.
All righty. Okay. I think it is too. Don, you have a good day. Stay safe, stay healthy, and I'll talk to you soon.